All right, what up? It's Ruben from TG. In today's video, I want to talk to you about how to buy out of the money call options so you can be profiting on these momentum trades just the way we do. And I'm going to give you an example with SOUN. Okay, so just a quick update on the yearly performance. Today this was July 3rd. So 53.99%. It will update today. And today I took a couple losses actually. So let's just look at that real quick. Upstart was a win, 7% shares. Mara, UNH, AMD. I mean, these were all losses. But the important thing is, so this year to date will take a little hit, probably like a 3% or something like that, which is not bad. But the main thing is that consistent process and discipline over time is what matters the most. Okay, so just because there was some losing trades does not mean that um, it's going to define my yearly performance. Okay, so don't take it too hard. Just be mechanical about it and continue moving on. Okay, so again, let's talk about out of the money call options, and I'm going to give you an example of SOUN and how we're trading this with a call out of the money call option. Okay, so let's talk about what is an out of the money call option. Okay, so first, an out of the money call option is a strike price that is higher than the current price of the stock. Okay, so here's an option chain, and right now I picked the $13 strike. Okay, this makes it an out of the money call strike, because the strike that I picked 13 is higher than the current price of the stock, which is 11.22 right here. Okay, so again, that's what makes my option contract out of the money. It's the strike. That's all it is. It's not the expiration. It's not anything else. It's just the strike. The strike is higher than the current price of 11.22 right here. You can see this right here, 11.22. Okay, so that's what makes it an out of the money call option. And this is exactly how it works. Okay, let's say that got a bunch of drawings here. Let's remove this. When you get a long call option, and that's out of the money, as the price of the stock goes deeper and deeper in the money, right? Let's say it starts right here and it goes in, you get more value. You have an unlimited amount of profit potential. Okay, that's why they're so popular. It's unlimited profit potential. You could turn $100 $100 strike into $300, $400, $1,000 per contract, $6,000 is very, very possible, especially with uh, very high momentum tickers like Tesla or Nvidia. Very, very possible. Okay, that's why they're so popular. So my strike again is the only thing that makes my strike my August 15, 13 strike call option on SOUN is that the strike that I picked, the 13th strike, is higher than the current price. That's what makes it out of the money call option. Okay, so why do people trade? Let's talk about the risks first. Like, what comes with the risks? Because this is really important to answer why do people even trade them. Okay, so risk number one, it's lower probability. The chances of it expiring worthless is very, very high. All the out of the money call options here, which I'm going to highlight right here, all of these, I'm going to change this and I'm going to make it a red box for you. All of these have high probability of expiring worthless. Okay, because there's a Greek called theta. Theta is designed to take your contract from whatever it's worth all the way to zero. We hate theta. It is our worst enemy. Another thing that has another high chance of expiring worthless is the delta. The delta is extremely low. The delta column right here, which you'll see right here, this delta column At the surface level, it tells you how much your money you're going to be making on per dollar move that the stock makes, right? But the way we like to use the delta as well too is a probability measurement tool. So if you have a probability of 0.94, that's a 94% chance that this strike, that the $7 strike, is going to end up in the money. The main objective that you want to try and do when you're getting an out of the money call option is to go from out of the money to into the money as quickly as possible. The quicker you could do that, the more money you will make before even expiration comes by. Okay, and so when you're picking an out of, if you see the delta value right here, you can see here that it gets lower and lower, and the further it goes out of the money, it's even lower and lower. So if you pick $7 strike, you have a very low probability of going in the money, which has a very high probability of expiring worthless. That's two risks right there. Low probability. Time decay is the risk that we were talking about, and also volatility sensitivity. Right now, SOUN has a very high IV, which it's a type of stock that can be in high IV environments for a very long periods of time, but during earnings, if this goes up and then it reduces, this will crush your out of the money call option. It will take it from 50 cents probably down to, for all the way from 50 cents all the way probably down to like 10 cents. You will lose a lot of your money there. Okay, so those are the risks. Why would you want to choose that anyways, right? Well, these are great for momentum trades. Okay, SOUN at the moment, what we're seeing with SOUN is a momentum trade. I'm gonna these levels right here that you see, like 13 and 12, these like purple line colors, and 11. These are levels that are being given by Gextron. Gextron is a tool that we use to figure out future uh, support and resistance levels that can, go against our trade, and also expect the move. It helps us know what the expected move by a specific expiration date can possibly be, right? And so what we're seeing with SOUN at the moment is that it's picking momentum, but there's a couple things in the way, which is this $12 strike and this $13 strike. Okay, now with that said, the reason why we pick a $13 strike is because it's cheaper, right? You can see here it's $1 versus $2. Okay, so I can leverage my capital more efficiently. When I trade with a six-figure main fund, okay, I'm not the the cheaper the strike is, the more I can be capital efficient. I can use less capital to still make a good return on it. Okay, so that's reason number one. Two, out of the money call options are great for momentum. Okay, they're great for momentum, and what I mean by that is that there is this column called gamma. Okay, gamma is right here, this column right here. Okay, now gamma, the way to think about gamma is that it's the gas pedal to the delta. Okay, so here's what I mean. You can see here 0.09. This is a high level gamma. This is a high level gamma. This is a high level gamma. We want to capture all this, and this starts at a out of the money strike. Okay, and when we capture all this high gamma, we make quicker delta, which we make more money quicker than at the money or in the money. Here's an example. Here's a gamma curve. Okay, if you start at a very far out of the strike money, you run the risk of, think of like delta like the engine, right? If your strike has a good engine, okay, you want to have good horse, you want to, and the gamma is the gas pedal. If you're like all the way here, it's like you're barely tapping on the gas pedal. If you're getting a strike here or here, it's like that's it. Like that's the end of the juice. There's nothing else to. You can't press on the gas. You want to get the ramp up. The ramp up is where you make the money here. Okay, and so that's why we pick an out of the money strike, because we want to capture that gamma and get catch that ramp up to make the quickest amount of cash at the shortest time possible. That's why we pick an out of the money strike. So when I'm looking at SOUN, I'm saying, okay, this can go to $15, this can go to $13. I want to pick an out of the money strike that is going to start that ramp up, and I can make a lot of money, a good return at a very short rate as possible if I'm right. The quicker I am, if the trade proves to be that I'm right and it's moving in my direction, then I will make more faster money than I would with any of the other strikes here, in the money or at the money. But it's always about picking a contract that has good probability. Okay, to avoid that risk, just pick a contract that has good probability, anywhere from 50 to 35. Pick an expiration time decay to fight time decay. Pick an expiration that is far out. If you think it's going to take 2 weeks, pick something that's 4 weeks out. If you think it's going to take a 1 day type of trade, pick something that's 2 days expiration, and so on. Okay, give yourself some time to combat time decay. And volatility sensitivity, you could just do that with like higher expiration as well too. The further expiration you go out, the less volatile strikes are. Okay. So that's it. So again, just like a quick recap, before you buy an out of the money call option, just always understand the time decay, have a plan, when to sell. Only risk what you can afford, because it's defined risk. So if you only put like $500, you only lose $500. If you put 1,000, you only lose 1,000, and so on. Okay. And if you want to try and capture these trades with us, know when we exit, when we enter, when we get stopped out, and all that good stuff. I'll put a link in the description box that you can check out to join our private Telegram group. If you have any questions about out of the money call options, leave them in the comments down below and I'll get back to you. All right. And I'll see you on the next one. Peace.